Hi, this is Chris Parry from Equity.Guru. Today's 3-minute hit is a little education piece on diversification. For those that don't know what diversification is, it's a little self-explanatory. Basically, it's an investment strategy where instead of saying, I will buy all Mickey Mantle rookie baseball cards and try and corner the market, maybe I'll buy 10. And maybe I'll buy a couple of Babe Ruths, and maybe I'll buy a couple of Jose Canseco's. Diversifying your investment across multiple places means that if one of the places where you've anchored your money doesn't quite work out, if it has a bad day, if it drops through the floor, that you've got money in other places to support your investment, right? So in a good, let's say 25 company portfolio, if 2 companies are in uranium and uranium spikes through the roof, great, you benefited. Maybe you can move a bit of money towards those 2 companies to benefit from that, right? If you've also got money in rare earths, in 3 companies, and the market falls out the bottom, those losses are offset by the wins on the other side. Now, some people, those that are more into risk, those that really turn up at the blackjack table and put everything down on the first hand, those guys say, well, what's the point in that? If you're just offsetting, you're never really winning. It doesn't really work that way. You know, what you're really looking at is markets over time generally rise. So that's great. You have your money in the market, chances are on an average, it's going to increase in value over time. But if all of your money was in, let's say, I don't know, Netflix last year, and then one day you wake up and Netflix has dropped a bunch of subscribers and stocks drop 70%, I don't know that the market generally increasing is doing you a lot of good at that point, right? So missing some of the rise to protect from some fall, to me, is smart money. It's how you get through recession here, an economic downturn there, a bad climate for a certain sector that you happen to like here. Guys who are all in on cannabis and have been for the last 3 years because, damn it, it's going to turn around at some point. Those guys are not diversifying. They may be invested in 20 different cannabis companies, but that ain't diversification. Being in 5 cannabis companies and maybe 5 mining companies and maybe 5 biotech companies might have done you better. For mine, we're in a downturn right now, market-wise. So I've been for the last year or so moving everything into cash, and that isn't diversification as much as it is just a damn protection and the ability to stay fluid and come back and hit certain companies at the right time, get in, get out, but mostly protect yourself from that downside. I've been in cash because I think the economy is going to shit. The Fed doesn't know what it's doing. And even though there have been increases over time, they've been offset by decreases. So that cash strategy has worked. But when you're all cash, inflation hits you, right? The dollar valuation falls over time. Your ability to spend that money on things lessens because inflation is going up the other way. So having all your money in cash, it's okay, but you're missing out on a lot of things. Now, in the meantime, you've got companies that defy the market, right? Like even in a downturn, even in a crash, well-run companies doing well-run things is always going to supersede the general tides. It may not be on a day, maybe not even a week or a month, but in general terms, if your money is in a company that is doing the right thing, that has its downside protected, is flush with cash, isn't a risk of running out and one day just going to zero, that's a good place to ride out a bad market. Now, we've been talking recently about a company called NYSE, which is a perfect example of what's been happening here. The markets are down, resources are down. NYSE gone from 80 cents to about $1.15 in the last couple of months while we've been talking about it. So why has it gone up like that? Why? Well, because of the reasons we were talking about it. Well-run company in a space that's hot. Going out there and being able to make big boy moves instead of being the victim of the market, instead of having to say, well, there's nothing we can do. The market's down, it's pushing everything down, it's taking our profits, can't raise money. These guys are big boying the table, right? They're the bully at the poker table. They're out there, they've raised money, they've pushed their project forward. They're getting their projects are based around rare earths and metals that are going to be required to greenify the power grid, to build electronics, to move society forward, right? All stuff that's in short supply, all stuff that their projects have an abundance of. So that's a good starting point. But hey, are you ever going to get that project off the ground? I'm glad you asked. So these guys just went out and announced a merger with a SPAC in the US that gives them access to a bunch of cash that has been unallocated to this point. They've also gone out and done 2 debenture deals to make cash available to them when they need it, so that they can just say, so is it time to build a mine yet? Cool, let's do it. There's still a lot of work to do. There's still permitting, and there's still more money raising, and then getting the institutions on board. But a $300 million company that has managed to bring itself from, let's look at that stock again, from 85 cents at the beginning of August to $1.17 at the end of September. That is a significant jump. It is a great jump at a time when almost everything else is down 20 to 30%. It just goes to show that a really well-run company with smart people at the helm in a hot sector with a project that is just creaking at the seams with ore, man, how can you go wrong? So diversification doesn't mean putting all your money in NYSE, but it does mean putting some in companies like that are on the way up, while protecting your downside by having money in other places, other sectors, other areas, in case one day NYSE wakes up and no one wants rare earths anymore, or someone's found some salmon on the project that needs to be moved, or I don't know, like the Russians invade Poland. You can't always tell what's going to happen in the world. Sometimes even the best things come down. But diversification means if you do have cash that you're sitting on because you're worried about the economy, that you also watch for opportunities while that economy is creaking, of things that are going the other way, of things that are undervalued, of things that might protect your downside, that maybe only drop 10%, but the price you're getting in is good anyway. Diversification means I love NYSE, but it's only 3 or 4% of my holdings. So hey, if you enjoyed this video, which was clearly longer than 3 minutes, but hey, sue me, hit the subscribe button and come visit us at Equity.Guru for more information. Oh, and if you like NYSE, NB is the ticker symbol.